Hey, Quasar Markets Live, Dr. Alan Ellman. How are you today, Alan?
I'm doing great, Steve. Always good speaking with you.
I love it. Alan is the president of the Blue Collar Investor Group, and let me tell you something, Alan. If you want to learn options, I pretty much know everybody in the options world, and there's Alan Ellman knows covered call writing. And the interesting one today is about ETFs. And I think a lot of people get risks on and risk off on certain stocks, but people feel more comfortable, and ETFs are very popular. So I'm excited about this one today.
Yeah, there's a lot of ETFs now that have become super duper popular by incorporating covered call writing into the actual ETF, and it's been exploding. And one of the reasons I chose this topic for the Quasar audience is because I've been getting so many emails asking me about the efficacy of using these particular types of ETFs, thinking, you know what, I could do covered call writing without actually having to do the work. Let the ETF do the work for me, and I'll get the same benefits as if I were doing it myself. But as you're going to see, Steve, that's just simply not the case. But that's the reason why I chose this topic. So, covered call writing ETFs, do they deserve to be so popular? We'll let the audience make the final determination by the time we end this discussion.
All right. Well, I'm going to let you do it. I'll leave here and let you go to it.
Thanks, Steve. Okay, so let's move on to the next slide where we're going to talk about the definitions of covered call writing ETFs. Well, an exchange traded fund is a basket of stock. It's like a mutual fund, but it trades like a stock on an exchange, so you can buy and sell it during the course of the day, and many of them have options associated with them. So they consist of a portfolio of stocks, and the covered call writing ETFs leverage those securities within the ETF by selling call options against those shares. So why they become so popular? Well, as you know, Steve, investors are always striving to generate high yield returns. And when people say, you know what, not only do I own these securities, but I'm also selling options against them, generating another income stream. That's the thinking behind it. And that's why so many people have become interested in this particular type of security. So what I want to do is I want to show members of the Quasar community uh, some of the things they should know about these particular types of securities before making a determination to include them in their portfolios. So we're going to be exploring three of the more popular covered call writing ETFs. And by the time I'm done speaking, I think your audience will be able to make a good decision about them. Okay, so let's move on now to the next slide. And these are the three very popular covered call writing ETFs. I'll just give you a very quick overview as to each of them. JP Morgan Equity Premium Income ETF, listed on the New York Stock Exchange, the ticker JEPI. Now, they use a low implied volatility. That means securities that aren't all over the place, which I kind of like, and a well-diversified S&P 500 stocks. Now, I haven't been able to determine how they screen for these stocks, but I do know they use options out of the money. They specify deltas of 30, which means one or two strikes higher than current market value. So they're agreeing to sell the shares at a higher price than it's currently trading for. So that's what, and they're using 1 month out. So there's a few things about this particular covered call writing ETF that I actually like. But as you'll see in a minute, I'm going to show you why I don't like any of them. All right, the second one we're going to explore that's very popular is the Global X NASDAQ 100 covered call ETF, listed on the NASDAQ exchange under the ticker QYLD. Now, what they do there is they write covered calls at the money. So they write a covered call at the same price that the stocks are currently trading for on the NASDAQ 100. And the NASDAQ 100 are 100 of the largest non financial companies that are listed on the NASDAQ exchange. I'm talking about the big boys now: Apple, Meta, Alphabet, Microsoft, Tesla, Nvidia, Netflix, you name it. The real big large cap tech companies. You own one share of the NASDAQ 100, then you own pieces of all of those companies. Now, the corresponding ETF for the NASDAQ 100, the triple Qs, QQQ, and I have to tell you that of all the securities I've written covered calls on in the last 30 years, that's probably the one I've used the most. Now, that doesn't mean that I use it all the time, because there are times when technology isn't in favor. And then, of course, I completely ignore it. So I'm in and out of it, but I've made a lot of money selling options against those. But the question is, will a covered call writing ETF based on selling at the money calls on the NASDAQ 100 stocks? That we're going to be exploring in just a minute. The third of these popular covered call writing ETFs we'll look at is Global X S&P 500 covered call, which is listed on the New York Stock Exchange. The ticker is XYLD. Now, this is a passively managed fund compared to the others. That means that it's based on a benchmark, the S&P 500, and they sell at the money calls on the index itself. So when it says passively managed, it's like an index fund. Computers can do it. You don't need somebody making decisions. It's just based on that benchmark, and the type of options they're selling are at the money. There's a big disadvantage, by the way, of doing at the money, because you're not getting the advantage of share appreciation, which you would get, let's say, with JEPI, which sells out of the money. So before we even get into comparing these three covered call writing ETFs with a broad market low expense ratio index fund, which is what I'm going to do in a minute, I would tell you that if somebody just said to me, of these three, which one do you like the best? I would go with JEPI. And that's because they're doing out of the money 30 delta, one or two strikes higher than current market value, giving the opportunity for two income streams: one from the option premium, which is what the big deal is about covered call writing, but another allowing share appreciation from current market value up to that out of the money strike. So that being said, that's the one I would pick. But let's move on to the next slide, and let me tell you a very important point that we have to factor in when we're making these kind of investment decisions. So one of the most important factors in determining returns of these ETFs or mutual funds is its expense ratio. Now, John Bogle, the founder of the Vanguard Group, one of the first books I ever read on investing was Common Sense on Mutual Funds that he wrote. And in the book, he made the case that one of the most, if not the most important factor in the success of a fund is its expense ratio. Now, these are administrative, marketing, management fees inherent in that particular security. And his point is that the most successful funds, ETFs or mutual funds, are the ones that have the lowest expense ratios. Now, index funds, which he was a huge proponent of index funds. The statistics showed that these low expense ratio broad market index mutual funds outperformed 70 to 90% of the actively managed funds because their expense ratios were much, much lower. Now, these expense ratio fees are deducted from the overall performance of the ETF. So let's get down, Steve, let's get down and talk some numbers here. Let's compare the three popular covered call writing ETFs to the Vanguard 500 index for Admiral shares. The ticker symbol is VFIAX. Now, that's a broad market, low expense ratio mutual fund based on the S&P 500. So the expense ratio of that mutual fund, VFIAX, is 0.04%. Now, there are even some S&P 500 mutual fund indexes that are even lower, like 0.03, maybe even 0.02, but we're going to go with the Vanguard. Still very, very low, 0.004. Now, Let's compare it to those three popular covered call writing ETFs. First, JEPI. It's 0.35%. Well, that doesn't seem like a lot, but it's 9 times that of VFIAX, 9 times. Now let's look at QYLD and XYLD. Their expense ratios are 0.60%. Once again, that doesn't sound like a huge amount, but that's 15 times that of the index fund. So when you start investing in these funds over months, years, and decades, that's going to make a humongous difference in the portfolio values that you have in your investments. So that is a huge factor that these covered call writing funds have to overcome, and they just simply don't, as you're going to see very shortly. Now, let me just add one more thing, Steve, before we move on to the next chart, and that is that the one thing that these covered call writing funds miss out on, it's really not one, it's really three, okay, is that stock selection. Okay, the one that comes closest to stock selection is JEPI, because they say low implied volatility from the S&P 500. I don't know how they screen, but you're going to see from the chart that even that doesn't work. But that's the one that comes closest to screening. The others, QYLD, XYLD, they go by a benchmark, the NASDAQ 100 or the S&P 500. That includes, by the way, the good, the bad, and the ugly, right? So if you were doing as a retail investor or as a fiduciary covered call writing by yourself, you could pick the best performing NASDAQ 100 stocks and do way better than going by the entire index. Same thing with the S&P 500. You don't have to include the losers in there. Just focus in on the best performers at that particular time. And that may change week to week, month to month. So it couldn't possibly do as well as we could do as individual investors. So you got the expense ratio, the lack of stock selection, except with the possible exception of JEPI. What about option selection? Well, you notice they either did all at the money or all slightly out of the money, that's 30 delta. Well, there are times when you're going to want to use different deltas. You're going to want to use in the money strikes, for example, when the market is volatile or uncertain or bearish, giving you the advantage of the intrinsic value component of the option. And so by just picking one strike fits all, you're doing yourself a tremendous disservice, which these funds do. And finally, and perhaps the most egregious, is that there's no management. You know, you enter the trade, you cross your fingers and pray. There's no management, there's no exit strategies. That's it. You enter the trade based on one size fits all, and then you wait and see what happens. So that's the reason why you're going to see the chart in just a second and why it looks the way you do. So, Steve, without further ado, let me show you the 1-year price chart of the mutual fund, the VFIAX, and the 3 covered call writing ETFs. So on the top is the VFIAX, which, by the way, I also did the actual benchmark S&P 500. Now, you can't tell that I did 2 of them on the top because they overlap exactly the same. So there's a dark blue line and a red line where that top red arrow is, and that shows that in that last year, the mutual fund and the S&P were up 17.02%. Now you'll notice they're in a completely different galaxy from the 3 covered call writing ETFs you see towards the bottom. Now JEPI, which is the one I told you I like the best of the 3, although I don't like any of them, you could see in that same time frame, the purple line, it was down 3.28%. XYLD, the red line, down 5%. QYLD, the light blue line at the bottom, down 5.77%. So, you know, they say a picture is worth 1,000 words. Well, this one's worth 1,000,000 words. And it will tell your followers of Quasar, whole Quasar community now, just remember this graph, remember this chart when somebody tells you that it's a great idea to invest in a covered call writing ETF. Just think back about this chart and then do your own research and come to your own determination. I never tell others what to do, Steve, but I'm happy to share what I'm doing. And what I'm doing is having no part of these covered call writing ETFs. I love the strategy. I've been using it for the last 30 years. It's made a huge difference in my life, in the quality of life of my family, and educating thousands of people from all over the world through the blue collar investor. So if we can go to the last slide and just kind of summarize those. For those seeking to beat the market on a consistent basis and many years significantly, absolutely covered call writing will offer that potential once the strategy is mastered. What stock am I going to use? What option am I going to use? And then how do I manage my trade once I enter that trade? Now, on the other hand, covered call writing ETFs, in my humble opinion, do not provide such opportunities. One, because the expense ratios are 9 to 15 times that of a broad market index fund, and they don't do stock selection, option selection, nor position management, and therefore you end up with the kind of chart that I just showed before. That's what I have, Steve. Steve, I can't hear you.
And I'm so excited that takes out some of the risk out of the covered call writing, right? By having ETFs.
Well, you could use, Steve, you could, you make a good point. You could use covered call writing against ETFs. Yes. But the point I want to make to the Quasar community is that covered call writing ETFs just simply don't work.
Right.
They underperform. And the chart that I showed that the underperformance wasn't just by a little bit. It was in a whole different galaxy from the way the market performs, the benchmark, the S&P 500. So yeah, I mean, covered call writing against ETFs gives you great diversification. You could generate great cash flow. That's completely different than letting some ETF do the covered call writing for you, in which case you're going to underperform. You're not going to make the kind of money that you'd like to make. And
Right.
in many cases, you're actually going to lose portfolio value. Just remember that chart that I showed, and that will tell you all you need to know.
Very cool. You know what's interesting, Alan? You were telling me earlier that you have a webinar tonight. Is that right?
Yes, I'm doing a webinar tonight with Barry on credit spread. So in the last 2 years, Steve, we've been working on a new credit spread calculator. It's actually taken us 2 years to develop this spreadsheet. Um, it's really an amazing spreadsheet that allows you to walk through the whole process of entering your credit spread trades, managing your trades, knowing your risk, knowing when to get it in and out, whether or not it's because you're losing money or because you're making money too quickly. And we've also have a new book on credit spreads based on a conservative approach. Now, I thank you for bringing that up, Steve. I want to mention that registration on my website is closed, but
Mm.
if anybody in the Quasar community would like to attend, it's 8 p.m. Eastern time this evening. Send me a direct email to Alan, ALAN, at thebluecollarinvestor.com, and I will send you a link to the Zoom call, which will get you into the room. And it come a few minutes early because we have more registrations now than the platform allows, but there's always some that don't attend. So
I
yeah,
love
send me an email and I'll send you the Zoom link. And I'm more than happy to do it for anybody who's a member of the Quasar community.
I love that. Look, credit spread calculators are not they're not cheap. And the book, you spent 2 years and you are doing a webinar for people. I really appreciate that. I think that's I think education is always the key to options. It's one of my rules. Options isn't scary. So I love this. All right, ladies and gentlemen, look, I've known Alan a very long time now. I trust him. I give him the Quasar Markets approval here. give him an email. Just say hi. Even if you don't want to go to the webinar, just say hi. Alan loves correspondence with people, and trust me, I know he does. Alan at thebluecollarinvestor.com. One more time, Alan at thebluecollarinvestor.com. Send him an email. Say hello to him. He loves emails, and he definitely will put you in that webinar tonight. Alan, for all of us at Quasar Markets, thanks, man, so much. For we'll see you next week.
Thanks, Steve. Take care.